Hello, I'm Anthony Saglin-Benny, Chief Market Strategist at Ameriprise Financial. The first half of 2025 was filled with extremes and uncertainty before ultimately ending on a positive note. Tariff friction fueled major market volatility in April, but markets later reversed course and rallied even higher in May and June. Still, open questions remain about future trade developments, the strength of corporate profits, and the trend line for inflation and interest rates. Where might we go from here? To help you make sense of the situation, I have a great panel of experts with me to share their insights and predictions. First, I'd like to introduce Russell Price, Chief Economist at Ameriprise, and Brian Erickson, Fixed Income Strategist at Ameriprise. Thank you both for joining me. Russ, I'd like to start with you. Stagnant economic growth, persistent inflation, and the deployment of tariffs on U.S. trading partners are leading some to speculate that a recession may be in the cards in the back half of the year. What's your forecast for the U.S. economy for the remainder of 2025?
Well, you're right, Anthony. The first half of the year was particularly bumpy from an economic standpoint. Tariffs and the threat of tariffs caused tremendous fluctuations in trade volumes. Consumers and businesses also adjusted their spending, investment, and hiring decisions in reflection of tariff related uncertainties. Now, as we enter the second half of the year, it appears that worst case tariff scenarios appear unlikely. That is, the very high tariff rates that the president initially unveiled at the start of April are likely to be negotiated lower. We still expect average tariff rates to rise materially, but to levels that should be economically digestible. That is, weigh on near term growth rather than curtail it. Overall, we look for U.S. economic growth to remain bumpy, but positive this year, and we estimate real gross domestic product to expand at a pace of about 1.5%. Further, we're optimistic for economic growth prospects in 2026. The economy's fundamentals are in fairly good shape, in our opinion, and various provisions of the recently passed One Big Beautiful Bill should offer some added economic stimulus via select tax cuts and higher government spending. Meanwhile, we see inflation is likely to rise somewhat over the second half of the year as tariffs boost some import costs. We don't think the modestly higher inflation rates that we anticipate, however, should impede Federal Reserve officials from cutting interest rates, as Brian will discuss in just a moment. In May, consumer prices via the Labor Department's Consumer Price Index showed inflation to be 2.4% higher year over year. By the end of this year, we currently forecast the inflation rate to climb to about 3%, then once again begin to decline as we move into 2026. So, Anthony, let me turn it back to you in the markets. We've seen a lot of volatility in the first half of the year, with equities initially moving into bear market territory, then making an impressive comeback. It appears that investors are disregarding the noise and pushing stocks higher, despite trade friction and other concerns. In your view, is there anything that may unsettle investors in the second half of 2025, or do you think the market can end the year higher?
You're right, Russ. Equity markets proved remarkably adaptable and resilient in the face of geopolitical shocks and trade uncertainty in the first half, mostly because economic and profit conditions stood on firm footing throughout. But with stock prices now back near all time highs, the market largely assumes a pretty benign investment environment in the second half. We'll just have to see how the economic and profit data evolves and whether that's the right call, or if trade impacts start to dent the outlook and increase market volatility. I would highlight, though, that a diversified portfolio performed pretty well throughout the first half and could help investors if markets grind higher, help them participate, or insulate during a potential downturn in the summer or fall should markets experience another bout of trade-related volatility. I think the second half is going to come down to how economic and profit conditions perform against expectations. But at least from a corporate profit standpoint, expectations for the rest of the year appear achievable, particularly if consumers and businesses remain on firm footing, which could help support stock prices. Tech and AI related businesses are projected to remain major drivers of earnings growth in the second half. And if tariffs and trade don't significantly impact growth or inflation, profit trends could improve in the second half for other areas of the market like financials, industrials, consumer discretionary, which could help support elevated stock multiples. Overall, I think the U.S. stock market reflects a high degree of optimism right now, similar to where we were at the start of the year. That raises the risk of a temporary drawdown if the script doesn't go as planned. However, we're unlikely to revisit the April lows, and we'd be buyers of high quality U.S. stocks if trade related volatility suddenly returns. And if economic activity remains firm, corporate earnings are growing, especially across tech, and unexpected bumps in the road are limited, U.S. stocks have an opportunity to grind higher through the rest of the year. Finally, attractive valuations, easing monetary conditions, and increased fiscal spending across Europe provide solid diversification opportunities outside of the U.S. that can help balance an overall equity portfolio through the remainder of the year. With that, I'd like to get some perspective from Brian on the potential investment opportunities in fixed income and cash. Brian, the Federal Reserve continues to be concerned about the potential impact of tariffs on the economy, and as a result, are keeping interest rates steady. The fact that interest rates appear to be in a standstill may make it appealing for investors to hold a higher level of cash in their portfolio. Is that the smart move?
Well, we still think that fixed income is a very attractive asset class. True, the Fed reduced policy rates by a full percentage point in 2024. This year so far, they've been holding steady, waiting to see more data on inflation and the labor market. We forecast by the end of the year, the Fed's likely to lower rates by another 0.5%. As clarity comes to the fore related to some of those dynamics the Fed has been watching, and that ultimately that will lead cash yields lower through the year, end of the year and into 2026. When you look at this year, it's been really an interesting year for fixed income already. Through June 23rd, the U.S. Aggregate Bond Index actually outperformed the S&P 500 with a 3.2% total return. And then in the last 5 days of the first half, the S&P 500 eked out a solid win to best the bond index in the first half overall. That said, the risk-adjusted return on the fixed income U.S. Aggregate Bond Index has been very attractive, and I think that underlines some of the opportunity that's available in the marketplace today. Now, in the first half of the year, we had some dynamics impacting the tax-exempt municipal space, one being the big, beautiful bill and potential tax policy changes that could impact the municipal space overall, as well as policy changes that are impacting higher ed and the approach of how the federal government funds higher education. We're really creating a headwind for the tax-exempt municipal space. We see those clouds as largely parted, as has the additional massive supply that we saw here, particularly even at the end of the first half, where you had a lot of issuers coming to market trying to get in before any kind of trade policies were put in place. But ultimately, that supply backed the market up and created better value, better opportunity, and still some of that remains in the municipal market. As a result, we've shifted that to an overweight for taxable investors and still see that as a solid place for investors to put money to work. Now, again, I mentioned the fixed income is an attractive asset class, and I think what underlies that is that historically the total return on a fixed income investment is linked to and largely driven by the coupon or the yield that the investor invests in when they first put their money to work. That becomes a driver of where total returns go over time. And today, with high quality fixed income at 4.5% to 5% yield and high yield at 7% yield, investors are looking at very attractive potential for returns over time on the fixed income space. It's very much a very different era for fixed income today, Anthony.
Really insightful perspectives, some great takeaways for investors. Thank you to our clients and other viewers for watching, and to my colleagues Russ and Brian for joining this conversation. If you have questions about current market conditions or would like to receive additional timely insights from the Ameriprise Investment Research Group, please contact your Ameriprise financial advisor. Thank you.